stay with the inflation discussion and the ability and tools at the Fed's disposal to manage some of this. And I think, you raised some really good points in that the Fed's tools are blunt and they are most effective in coordination with a variety of other actors who are all pulling in the same direction. The challenge, I think, at the moment, especially, is that the regulatory and trade type of policies that might be enacted here and incentives that might be enacted, these are intermediate to long-term solutions. And I think the fear here, and just to invoke a framework that I've heard Mohammed El-Arian articulate, you've got this idea that inflation starts in a very narrow sector of the economy, right? He sort of talks about lumber as being sort of the original start of where inflation began to enter the public consciousness back in sort of late 2020, early 2021. It's obviously spread into the energy sector most acutely, but you're obviously seeing it in a wide variety of sectors. And that once this so you got stage one where it's very narrow, begins to catch attention. Stage two is adaptive expectations. Individuals and companies begin to raise prices, both because their input costs are increasing and they're trying to maintain margins, and because the consumer is acknowledging that there's inflation and they're willing to spend more to get the same goods. The Fed doesn't really have any ability to moderate those stages of the inflation process. But the third stage is the most insidious, and that is where citizens, consumers begin to anticipate a sustained inflation cycle and build that into longer term expectations. And I think this is the role where the Fed can step in and have a very large impact, because this ends up being a signaling question, right? How do you signal to citizens and consumers that the Fed and policymakers will not tolerate a sustained inflationary impulse that devalues the dollar and all of the dollar-based liabilities that exist around the world? And so I think we're well into sort of stage two here. And the question is the Fed going to take the action necessary to short circuit this longer term inflation expectations spiral? And so do you think the actions and the statements that the Fed has made so far are sufficient to short circuit that? Or do you think that they're going to have to do more? And do you think that maybe that's what we're seeing being repriced in the bond market and it just hasn't had a chance to propagate to other asset markets?
Yeah, I think that's a fair point. I think that in terms of the Fed, I think that they've swung from being behind the curve to being with the curve. And I think they probably need to do a bit more to get ahead of the curve to really bring down those expectations. So, for example, this year the market is pricing, another maybe 200 basis points of rate hikes. Next year, maybe 2 hikes. So the next year one seems a bit too low. So perhaps it should be 4 hikes for next year. So maybe the Fed policy rate should get to like 3% or something like that. So I think the Fed kind of needs to move up in that direction. And I think the Fed's done quite a bad job in its communication. And, it always seems to be kind of catching up to something. So we had the Fed meeting a week or so ago. Then Powell had to come out with a speech at the beginning of this week to clarify that they are hawkish, and that's what's caused the latest move up in yield. So it tells you that the Fed is struggling to articulate its policy that well. So I think they're moving in the right direction to deal with it in this paradigm, and they could do a bit more. Now, on the question of the spiraling expectations, I know, El-Arian and many other summers have talked about this. I personally am a bit skeptical of the whole wage price expectation spiral sort of dynamic, partly because if you look at forward-looking inflation expectations, they're all relatively stable. Most surveys basically tell you near-term inflation, and then long-term it's going to be fairly well anchored. Secondly, so throughout this whole experience, you haven't seen this sort of de-anchoring. But secondly, if you look at the relationships between expectations, consumer surveys, even if you go back to the 70s even, what you find is that it lags actual inflation. So it never leads inflation. It's always like if inflation's 8% today, then inflation expectations pick up. If it goes down 6%, it will then also go down. So it just follows spot. And it's a bit more skewed towards salient prices like food and energy, things you interact with every day. And so those prices move around a lot. So I'm kind of skeptical about that spiral. And if you really did see that, I think you'd also see real wages go up much more quickly, which you're not seeing at the moment. And I think if you go back to the 70s and the 60s, we're in a fundamental different structure of an economy to back then. Back then, you had price controls that were being lifted. You had trade unions. The power dynamic between companies and workers was so different. And importantly, one of the big difference I don't think many economists quite appreciate, or academic economists appreciate, is how financialized the economy has become. So, from the 80s onwards, since the Big Bang deregulations onwards, there's so much financialization, of the economy. I mean, the amount of the most actively traded market in the world is foreign exchange. $6 trillion is traded every day in FX markets. 10 years ago, it was $4 trillion. So it's gone up like 50%, but world trade hasn't gone up 50%. But what has gone up is all this financialization. And that's important because that tells you that a big outlet for extra money printing or high-low rates is the financial sector always. Whereas in the 70s and before, you didn't have that outlet. So all of that money printing or whatever just had to go to the real economy. That was the only outlet. There was capital controls back then. There was limits to how much dollars you could take offshore. That was the creation of the offshore euro-dollar market. So I think that's one kind of big difference today. There's this outlet that you have for inflation that you didn't have before. And so for me to really see a truly inflationary paradigm going forward, I think we need to see a reduction of the power of big companies. So more worker power, employment rights. You'll need to see some kind of shrinking of the financial sector, perhaps even capital controls. Once you kind of do all of these steps, then you'll end up in an environment where you could have structurally higher inflation and higher wages. In the absence of that, I think that in the end, once the supply chain issues or supply side issues, ease up, then inflation will come back down, and we won't, have this. And so the expectation spiral won't be enough to be able to keep inflation high once all of these energy things start to come down.